Welcome to SEC Filings 102. This is a basic overview of some common SEC filings. Um, Again, we're at Investopedia, and you just search SEC Filings, forms you need to know. Now, they don't have all of them, but it's a great place to start. Um, just read through this. It says the SEC requires public companies, certain company insiders, and brokers and dealers to file periodic financial statements and other disclosures. Okay, so the public can, I'm reading this right here, the public can view the SEC filings by visiting Edgar, like as we discussed in the previous video. Registration statements are required when a company initially sells shares to the public, right? That's the IPO. Among the most common forms of SEC filings are 10K, Q, Form 8K, proxy statement, Forms 3, 4, and 5, Schedule 13, and the Form 114, foreign investment disclosures. The annual 10K report, for instance, provides a comprehensive summary of companies' financial performance. Proxy statements are presented prior to shareholder meetings before voting on the election directors and other corporations and other corporate actions. Now we have a little thing to show you the difference between a 10K and a 10Q. So you can see the 10K right here. It says SEC filing of 10K is done yearly by the company, right? So it's your yearly report, right? i.e. done once a year. But you do have quarterly reports, and they come out and they're called the 10Q. Now the 10K is in depth. Each and every detail is covered about every company. 10Q has less details. This 10K is audited. This one is unaudited. So a lot of times, like Tesla put out a report one time where all of a sudden they went from losing money to making, I think it was like $2.32 a share, and nobody believed it. They were like, no, wait till the 10K comes out. Nobody believed that they had just turned profitable like that quickly. So they're like, wait till the 10K comes out, wait till they get audited, because there's some accounting tricks that you can do to make one quarter look better than another. SEC filings need to be done within 90 days after the end of the company's fiscal year. SEC filings need to be done within 45 days after the end of the company's. Okay, so Q 45, K 90. Just remember, Q is for quarterly, K is for yearly. So for preparation of 10K, 10Q is needed, right? So those are some differences there on the 10K. Now, a registration statement, it just provides information about the securities being offered by a company as well as financial condition. The company preparing to offer securities will file a Form S1 registration with the SEC. And that contains the prospectus. This is a mandatory document that's given to any person who's offered to buy the company's securities. Now, you can read through this more, but something that has happened this year is SPOCs have come out, and SPOCs are a way for people who don't want to go through the regulatory hurdles to IPO. What happens is you have a SPOC, and it's a company that does all this, but they don't have any income. They're just a cash company. They're raising money to buy a company, right? So we'll have SPOC A, B, C, D, and they'll say, you know what, we're going to go and initially pay publicly traded company, IPO. We have no income. There's nothing here. We're just a cash company waiting to buy somebody up. And then all of a sudden, let's just pretend an electric vehicle company is like, yeah, we'll sell to you. And in doing so, we think we're valued at this amount. And then they'll go back and forth, and then they'll come to an agreement. Well, all they have to do is merge. So the SEC doesn't require all the data about knowing all the details of this company coming forth because they're not IPOing. It's kind of a way to get around. So anytime that you're investing into a SPOC, you're not having the details that you did if it were just an IPO. There's other advantages to it as well, but we'll just stick with that. And you can read the difference why companies go SPOC instead of IPO. Now, 10K and 10Q, I think we described that. 10K is an annual report that provides comprehensive analysis, right? So we understand that's the 10K. 10Q is the quarterly. right? Now, a Form 8K is what a company uses to disclose major developments that occur between filings. So let's say you are going to be sued because Apple says you're copying their technology. Well, you would put that out in the 8K. Apple's suing us, or let's say you've got a major announcement and you're a biotech company and you've just cured cancer. Well, you'd put that out in a 8K. So right here it says a Form 8K can include bankruptcies, receiverships, material impairments, and acquisition or disposition of assets or departures or appointments of executives, right? So Bob, the CEO, out of here, 8K, right? So 8Ks are important to let you kind of know what's going on in between. Um, Now, these proxy statements, I mean, it's investors can view salaries and management, and perks, et cetera, et cetera. Forms 3, 4, and 5. Form 3 is the filing and disclosure ownership amounts. Form 4 identifies ownership change. And Form 5 is an annual summary of Form 4 and includes any information that should have been reported. Okay. Um, Now you'll see a lot of news time. A lot of people will pop up a company because of 13D hits, right? Well, what that means is it's a beneficial owner report, right? So let's pretend Warren Buffett or the Baker brothers or somebody that's good in whatever sector they're doing. They file a 13D in a company. Well, if they're buying into it, then that means, you know what? Maybe I should buy into it, right? They know what they're doing more than I do, right? The Baker brothers are great with biotech. Let's jump on board with them. So it'll go in there and it'll cause things to spike. Now, if a company, let's just pretend a company's got 3 million float. Well, somebody files a 13D and all of a sudden they own 1.5 million. People are like, well, shoot, they're trying to buy up this company. I need to get on board, right? So that's kind of the 13D. Form 144 is insider to dispose of company stock. And then you've got foreign investment disclosures. You can read more about it. It's a little bit more deep than I want to go right here. And I've got, I mean, we can create a link to this, but this is just a picture of a Form 4, kind of explaining how to read it. Um, you know, who it is, chief medical officer, right, or is it the CEO or whatever? Date. This tells you what has happened. So, like, if you look at this, um, they got all this and they paid $0 for it. Well, what does that mean? That just means they exercised an option that they had. So them acquiring this, it's no big deal. It doesn't mean anything. But if the CEO were to go out and actually pay at the market price for the stock, well, that is a big deal. It's like, oh, okay, he's actually buying up this stuff. Now, a few other things I want to get to is it's called the S3. The S3 is a shelf registration, especially if you're playing biotechs or smaller low float companies. If you watch my video about Momo float stocks and how to play them, I explain a lot about the S3 and what the 424B5 does. But the S3 is a shelf. What that means is somebody can put out something that says, here, let's pull up the Edgar website and I'll show you. I'll show you what one looks like. Who just filed an S3? I think VTVT redid there. So an S3 lasts for 3 years, and VTVT's just ran up, and so they had to file a new one. So you see right here, 221,318. So I click on it, and what's it say? It says, you know what? We can raise $250 million from this. So what that means is they now have permission to raise $250 million. So they can put out an offering anytime they want. Let's say they put out an offering for 50 million. Well, they still have 200 million sitting on that shelf, right? If they put out an offering for 250 million, this shelf is gone and can no longer be used. Now, one thing that you can look at on here is you'll notice, do you see the previous S3? So this one was filed 2019, right? Remember, they last for 3 years, but this one was done in 2000. 18. So you need to read and understand what it is that what they're selling, what they're doing. This isn't a shelf offering because this is, if you read right there, resale of selling stockholders for this amount. So that's not a shelf, right? They're just selling stockholders just want to get rid of it. This was the previous shelf. So if you look at it, where did I miss it? There it is. See, it was a 250 million, right? February 27, 2018. Well, the thing to remember about this as well, guys, these last 3 years, but it's 3 years from the effective date. So let me show you this. A guy I know runs this site called Dilution Tracker. Great guy. I trust him. I subscribe to this. So if I look at VTVT, I come down here, and do you see how this one says pending effect? So what that means is it hasn't gotten an effect. And if I click on this, this is that S3 we were looking at that was filed in 2018. Okay, when did it get its effect? Look right here, 2018 at 3/19. So what does that mean? 3 years from this date, it expires. Well, guess what today is? It's 3/20. It's 3/20, 2020, right? So they're replacing this with this one, but this one needs an effect. You see how it doesn't have the effect yet? Well, the effect comes when what's happened right now is the SEC has received this S3. The SEC reads over it, and they're like, "All right, we've got all the correct information. It's great. Here, we're gonna give you the effect." The SEC actually gives them the effect and says it's ready to go. And once it's on the books, once it's filed, it can be used. That shelf can be used, but this shelf can't be used until the effect comes into place, and that's why you see right here pending effect. Okay, and this happens for S1s as well. Now, I mentioned in the beginning an S1 was for um, an IPO, but you can also do S1s for other things like pipes and stuff, and so those need effects as well. All right, I think we've done a good little overview here. If you have any questions, just let us know.